Hello, fellow traders, and welcome back to our channel. Today, we have an exciting topic lined up for you in the world of technical analysis. We'll be diving deep into one of the most recognizable and widely used patterns, the head and shoulders pattern. The head and shoulders pattern is a powerful chart pattern that can help us identify potential trend reversals in the market. It consists of three peaks, with the middle peak being the highest, the head, flanked by two smaller peaks on either side, the shoulders. Now, let's break down the components of the head and shoulders pattern and understand how to identify it on a price chart. First, we have the left shoulder, which forms when the price makes a high, followed by a decline. Next, we see the head, which represents the highest peak in the pattern. Finally, we have the right shoulder, which forms when the price rises again but fails to surpass the head's high. The most critical element in confirming the head and shoulders pattern is the neckline. The neckline acts as a support level connecting the lows of the left shoulder and the right shoulder. Once the neckline is established, we can look for a break below the neckline to trigger a potential reversal signal. This break is considered a bearish confirmation of the pattern. It's important to note that the neckline can also act as a resistance level if the price attempts to rally back up after the break. Traders often use this retest as an opportunity to enter short positions or tighten their stop-loss orders. To calculate the potential price target after the breakdown, we can measure the vertical distance from the head to the neckline and project it downward from the breakout point. This gives us an estimate of how far the price might fall. Remember, the head and shoulders pattern is not limited to just bullish or bearish reversals. Inverse head and shoulders patterns can also indicate bullish reversals in a downtrend. The only difference is that the pattern is flipped upside down. Remember, trading any pattern involves risk, so always practice proper risk management and use this information as a tool to support your trading decisions. When trading the head and shoulders pattern, there are a few key steps to follow. Let's walk through them. Identify the pattern. First and foremost, you need to identify a valid head and shoulders pattern on your chart. Look for three distinct peaks, with the middle peak, the head, being the highest and the surrounding peaks, the shoulders, being slightly lower. Ensure that the pattern is well formed and visually clear. Keep in mind that the time frame you trade on will determine the significance of the pattern. The head and shoulders pattern tends to be more reliable on higher time frames, such as daily or weekly charts. Confirm the neckline. Once you have identified the pattern, it's crucial to confirm the neckline. The neckline acts as a support level connecting the lows of the left shoulder and the right shoulder. It validates the pattern and provides a reference point for potential entry and exit levels. Wait for the price to break below the neckline to confirm the bearish reversal signal. This break is a key trigger for initiating trades. Entry and stop-loss placement. After the neckline break, you can consider entering a short position. Some traders prefer to wait for a retest of the neckline as resistance before entering the trade, while others enter immediately after the break. To manage your risk effectively, place a stop-loss order above the right shoulder or above the recent swing high. This will protect you in case the pattern fails and the price continues to rise. Target projection and exit strategies. To determine your profit target, you can use the projected price target based on the pattern's height. Measure the vertical distance from the head to the neckline and project it downward from the breakout point. However, it's essential to adapt your target and exit strategy based on market conditions, support and resistance levels, and other technical indicators. Consider taking partial profits along the way or trailing your stop loss to secure gains. Risk management and trade monitoring. Lastly, always remember to practice proper risk management. Determine your position size based on your risk tolerance and maintain a favorable risk-to-reward ratio. Monitor your trade closely, and if the market moves against you, be prepared to exit with a manageable loss. As always, trading involves risks, and it's essential to develop your own trading strategy and test it thoroughly before risking real capital. If you have any questions or need further clarification, feel free to leave a comment below. If you found this video helpful, please give it a thumbs up, subscribe to our channel for more valuable trading insights, and hit the notification bell to stay updated.